right, so I think we should be able to get this one done in an hour as well, so. Okay, so characteristics of muni bonds, the general characteristics. So you're held accountable for three issuers of debt securities: corporate issuers, municipal issuers, and the US government. These are all people who want to borrow money from you. And you can lend them some money and they agree to pay you interest. Now, the two risks you have in buying bonds are interest rate risk and credit risk. Interest rate risk is that interest rates go up and your bond portfolio goes down. That's what a lot of people are experiencing now. Now, that wouldn't be a problem for Northwestern because, they're planning on holding their bonds to maturity. They're not planning on day trading the bonds. But if you own bonds and the interest rates go up, the bonds go down, that would be interest rate risk. And then the second risk is credit risk. They don't pay you the interest and the principal. One of the largest municipal defaults in history was Detroit, Michigan. And Detroit, Michigan filed bankruptcy. Now, first test point is that's less likely to happen with a municipality than a corporation. Municipalities are considered, test question, to be the second safest form of credit. There's 50,000 municipal issuers. That's cities, counties, states, school districts, transit districts, with about $4 trillion in debt outstanding. And for the most part, this is where people put their real money. The money they don't plan on losing. And we have two types of these bonds we're going to be discussing. We'll be discussing general obligation bonds, and we'll be discussing revenue bonds. Now, a lot of times on the test, they could ask you the question in regards to a corporate bond, but they want to appease the MSRB by saying, yes, we had X number of questions on munis. So some of the questions aren't really muni questions. They're just bond questions that are camouflaged as muni bond questions. So when you buy bonds, we have different types of maturity. We have serial term maturity. That means all the bonds come due at once. So, California borrows $2 billion. They issue 20-year bonds, and in 20 years, we expect them to come up with the $2 billion to pay the principal. But a lot of times, the municipal issuers particularly will issue what are called serial bonds, where they have different maturity dates. If you get this, it'll be a definitional question where they just ask you, what is the definition? I had a guy in class, he said the way he's going to remember serial bonds is like a serial killer. They kill at different times. Really? Yeah, I'm not so sure that's how I would remember it, but oh well. Now, a balloon is just a larger than normal payment within the maturity schedule. So that means, as we go towards it, maybe I owe $100 million. I pay 10 million 20 years from today, then 15 million, then 20 million, then 30 million. And then that last year I owe 50 million. Now, the point about a balloon payment, just like it was your mortgage, right? If I say, hey, Lauren, is there a balloon in your mortgage? That means I'm saying, Lauren, do somewhere along the way, do you have to come up with more than the monthly payment? And the point about that is you present a bigger risk if you have to come up with a balloon, because who knows how you plan on coming up with that extra money, right? So these are the types of maturities we have for bonds. Okay, so first time for you to demonstrate your prowess today. All bonds trade over the counter. All bonds trade over the counter. What does that mean to say that a security trades over the counter?
It means that you're not purchasing the IPO, the initial public
Yeah,
offer.
well, that's the primary market. So in the primary market, you're correct. The issuer receives the money. That's the primary market. And then we have two types of secondary markets. We have test question auction order driven markets like New York Stock Exchange, where they just match buyers with sellers. And then we have over the counter markets where there's negotiated quote driven. I think, Lauren, a good analogy would be the art market, right? You can buy art from the artist. This person is pretty rich, but she says, I was admiring some of the art on her walls. And she says, yes, I'm a collector. And I said, well, what about that piece? And she said, yeah, she likes to buy art in the primary market because she likes the idea that the artist who's living is receiving the money from her. Now, she told me that, Lauren, but, I'm not an art person, but I said, well, that's not true, because right there, Catherine, I see that guy and that person's dead. She goes, well, Every once in a while, I'll buy art in the secondary market. You know, Gauguin is not getting 20 million bucks. Gauguin got 20 bucks from some tourist in Tahiti. The 20 million is going to the previous owner. Now, if you are going to participate in the secondary market for art, one place you can go is to Sotheby's and Christie's. That's an auction house, and they simply match buyers with sellers. They're not trading against you. In fact, they would assign a PhD in art history to you as an account exec to help you buy art. The other way you can buy art is from an art dealer. Now, when you're buying from a dealer, you got to be a little more careful, because that means the person has this in inventory. So when we say it's a dealer transaction, that means this person, let's just put this here. By the way, not only is this testable as a Muni question, we're doing Munis right now, but you know, it's also a test question about how markets work. You know, so let's put over here. Here's the bond desk at maybe Rauscher. Rauscher is a broker dealer, and they have inventory. And I'm looking for a quote on a municipal bond. And I say, what's your quote? And they say, Dean, our quote for that particular muni bond is 97 7/8, 98. The minimum spread I'm ever going to make as a dealer in municipal and corporate bonds is 1/8. That is the minimum spread. You should definitely know that munis and corporate bonds trade in 1/8. And they trade as a percentage of par. They trade as a percentage of par. So 98 is $980. A percentage of par. Par is 1,000. That's very testable.
Mhm.
And you know, par for preferred is 100. Now, a lot of times people get hung up on the 7/8. And so one thing we definitely want to know is that a 1.1% of par oh, come on, Dean. I'll just put the whole 1,000 there, just is $10. Now, in the bond business, it's kind of like every business has its own language. No bond person is ever going to say $10. If you want to sound like a player, you would say a point. So, you know, if you say $10, that's a sign that you're new, right? So now we got to be able to figure out what is this 97 7/8. Well, the 97 is easy because that's 970. Right. So we got to figure out what is that 7/8. And the way we're going to do that is we're going to take our calculator. Do you have a calculator with you, or you got one on your screen?
7 divided by 8 plus 97,
Excellent. Excellent. So yeah, there's a lot of ways to do it. I like that. 7 divided by 8. And then what I like to do is I like to times it by the bond point of 10. And that gives me my answer. And now I know it's 875. Now there's a couple ways to do that. You know, a couple ways to do that. So now let's put that here. We should also know that it's 1/8 is $1.25. Now that's also going to be important for us. 978, 75, because when we do primary underwritings, we're going to have a spread. And where the spread will be a point, and there'll be an 1/8 and 3/8, and then we got to figure out who made what based on, you know, what they were in the syndicate. Okay, so we've got our price here. Now, again, we got to be real careful here. So let's just, we're just on this quote saying, okay, what is this? This is where the customer sells. You know, whenever a customer is looking at a quote, the customer always receives the low price and pays the high price. What's that called? The securities industry. I'm joking, but. And so I am not joking about this part. So what do we call the difference between those two prices?
The spread.
Excellent, excellent, excellent. That's how we make our living. So if I give you my quote, maybe you're an order entry firm, you don't have muni bonds in inventory, or your customer, it doesn't matter. I work the bond desk. You say, Dean, what's your quote? I say 97 7/8, 98. You know, by the way, I have to give you the two-sided quote. I'm not allowed to say like, well, Lauren, tell me, are you a buyer or a seller? you told me that, then, if you said I'm a buyer, I'm going to mark it up, right? If you told me you're selling, I'm going to mark it down. So in our business, we give you the two-sided quote, right? And I say my quote is, and then, I have to honor that quote. So I give you my quote. I say 97.78, 98. As you see here, the dealer buys at the bid and customer sells. Dealer sells at the offer. In that stock, it's the same deal, but it's called the ask. But in a bond, it's called the offer. On your confirmation, very testable, we're going to disclose what capacity we acted. And so if you bought this bond from Merrill Lynch's bond desk, you would say Merrill Lynch acted as a dealer principal in this transaction. So I say, hey, Lauren, when you open an account with me at the Goldman Sachs or Morgan Stanley or UBS or Merrill Lynch, we're all called broker dealers, but any one transaction you do with us, we're going to be acting in our broker agency capacity and on your behalf, get the bond elsewhere, or we're going to act in our dealer principal capacity. And we're going to charge you a markup or a markdown.
I noticed that principal is always identified separately, but broker dealer seems to be interchangeable.
Well,
But
yeah,
when
the broker dealer, when it refers to the firm, is interchangeable, but not when it refers to a particular trade. So all brokerage firms are called broker dealers. And then in any particular trade, they're going to either act in their broker capacity or their dealer capacity. Right. So you're right. If I'm talking about broker dealers, those terms are interchangeable, but not in a transaction.
Okay.
So when you get your confirmation from a broker dealer, let's say you're a customer of Schwab, your confirmation will say Schwab acted in its, in this case, broker capacity, its agency capacity. And that means, Lauren, that Schwab didn't have that security in inventory. They went and got it from someone else. And that means you're going to pay this markup. And then you're going to Schwab a commission. So any one trade, you can't be a broker and a dealer in the same trade. You can be one or the other as a firm, right? Because you got to decide, do you want to make a commission or do you want to make a markup or markdown? We do have firms, Lauren, who don't have inventory. They never do, right? Some firms don't have inventory. And the term, it's not a test term, but we call those order entry firms, meaning, they don't have inventory. By the way, if you call Schwab, let's say you got your confirmation from any broker dealer. It says we acted in our agency capacity, our broker agency capacity. The other side is not on the trade, but it's available upon a request. So you say, Dean, I just got my confirmation. I see that you acted in your broker agency capacity. And so who is the other side of the trade? That means which firm, what bond desk. This is called a bond desk that we're discussing. As we said, some firms have a bond desk and some firms do not. I said, what bond desk did you get it from? That's not on the confirm, but that is available upon request. Now you're confused if you call me, Lauren, it says we acted in our dealer principal capacity. And you call me and say, Dean, who was the other side of the trade? I said, well, Lauren, you're a little confused because if on your confirmation it says we acted in our dealer principal capacity, that means you got it from us.
Mhm.
You bought it out of our inventory, right? So this is how we trade municipal bonds. All bonds trade this way. All municipal bonds trade over
The counter.
the counter, the negotiated quote-driven market. By the way, what negotiated means you don't have to take my price if you don't want to. You could say, hey, Dean, I don't like your quote. How about I give you, you're saying you want to sell it to me in 98. How about you give it to me at 97.78? So we can negotiate. Some people, like to negotiate. Some people do not. And it just depends on. That would be true of NASDAQ stocks, by the way. Right? NASDAQ stocks are our market makers who have inventory, right? So certain stocks trade this way as well. Okay, so we talked a little bit about the secondary market. As it relates to munis, we said munis are a little different in terms of how they trade as compared to like New York Stock Exchange stocks. They trade based on a bond desk. Some firms have a bond desk, some firms do not. In fact, Lauren, I might, if I have a bond desk, say, hey, Lauren, our firm does have a bond desk. We do buy and sell municipal bonds into and out of our inventory, would you like to put me, be put on the distribution list for our firm's offering sheet? Our offering sheet is the bonds we have in inventory and we're willing to sell to customers like you. By the way, please note, it doesn't say bid and offering sheet, just the bonds we have that we're willing to sell. I said, that's a pretty typical thing to send it to the doctor or whoever and say, hey, do you like tax-free income? We haven't got there yet, but that's why people buy muni bonds. Rich people buy muni bonds, poor people do not, right? So, we send that out. Okay, so let's clear up this slide. We said a huge part of the exam is distinguishing between GOs and revenues. I would suggest at some point in your study effort that you get a sheet of paper, fold it in half, and on one side, write all the terms associated with GO bonds, and on the other side, all the terms associated with revenue. Because a big part of your exam is distinguishing between GOs and revenues. Now, I think a lot of people get hung up, Laura. They think there's a gazillion types of muni bonds. Not true. There's only two, GOs and revenues. Now, granted, we're going to find out there are zillion subcategories. So, within these two categories, there's going to be a lot of subcategories. All right, so general obligation bonds, a debt security issued by a form of government other than the federal government. So what we're trying to tell you there, Lauren, is on this exam, states are municipal issuers of securities. So on this exam, when we say government, we mean exclusively the US government, because we consider states, 50 of them, to be municipal issuers. I told you there's 50,000 municipal issuers of securities and 50 of them are states. So that means 49,950 cities, counties, school districts. I always think of it as taxes, Lauren, or the price you pay for civilization. And the more civilization you want, the more taxes you're going to have to pay. I'm teasing my brother quite a bit recently because he's building a place off the grid. There's this whole movement now about going off the grid, and so he doesn't have water, he doesn't have power, he doesn't have. I'm kind of like, well, he's bragging to me about how little in taxes he pays. I go, I'm not surprised, Chris.
Have nothing.
Yeah, so anyway, I think it's kind of fun. I've been trying to convince him he probably wants to get a well and get, just get solar power and do all that kind of stuff. I'm coming to you from Las Vegas, and we are fortunate in Las Vegas on the state level that we don't have an income tax.
Same here in Florida.
There you go. So property taxes are exclusively for local government. So when we're talking about general obligation bonds for anything other than a state, we're going to be talking about ad valorem or property taxes. So here we have issuers would be anybody with taxing authority. Anybody with taxing authority can issue a GO bond, and that's going to be important for us because that's a key kind of distinction, is that GO bonds are backed by taxing authority. And that means these are organizations that can confiscate money. That's what, taxes are, the ability of somebody to confiscate money for you. So you just told me, Lauren, like my state and your state, our states don't confiscate any of our money as an income tax. And that is rare. Texas, doesn't either. Most states, California, where I left, top rate was 13%. Yes, that's why a lot of people go to Florida, and Nevada, and Texas, and getting out there. I was looking at census information for Florida. And it was crazy how many New Yorkers are heading to Florida. So,
yeah.
All right. So political subdivision is just a fancy word for local government, right? So in my example, I'm coming to you from Clark County. Clark County is a political subdivision of Nevada. I'm coming to you, Lauren, from Las Vegas. Las Vegas is a political subdivision of Clark County. I'm coming to you, Lauren, from the Clark County Unified School District. My house sits within the Clark County Unified School District. These are all people who want property taxes from me, right? The county wants some money, the city wants some money, the school district wants some money. And as I mentioned, that's primarily going to be a property tax, is how we're going to support local government. Let me clean up my slide. As we said on, as we said, whoa, I don't know what I did here. Hold on. Every so I hit some button, it does some crazy thing. All right. Do you have, can you see the whole slide again?
I can.
Okay, cool. If something happens, just know I'm working on fixing it. Right. So as we said, primarily on the state level, it's going to be an income and a sales tax. As we said, on the local level, it's going to be an ad valorem property tax. Now, I saw you're using STC in the notes when I was checking our notes this morning. And STC, Kaplan, Past Perfect, all of them have what I call legacy questions from the old 7 versus the current 7. Nobody wants to say they have less questions. So I just want you to know that on the actual test form, we're not going to make you actually do a property tax calculation. We're not going to say the assessed valuation is 500,000 and you're in a 2 mil taxing district. What is the property taxes? But, we should have a general understanding that they need to have the authority to borrow the money. And if that's going to be a GO bond test question, we're going to have voter approval to issue that GO bond. And it makes sense because that's what backing it is, the property taxes. So, before I moved here to Las Vegas, I had a place in the city of San Francisco, lots of infrastructure to pay for. And then I had a little place, 10 acres outside Yosemite, not a lot of infrastructure. The taxes are substantially different. But the Mariposa Unified School District wanted to issue some bonds to build a high school gymnasium. And they told me they think they can do it for 2 mils. And again, I told you, you're not going to have to calculate this on the test, but basically what they're telling me is 0.002 times my $500,000 assessed valuation, that they're like another 1,000 in property taxes to issue bonds to build this gymnasium. I actually said, Lauren, yes to that. But unfortunately, the majority of the county taxpayers said no. So the bond offering kind of failed at the get-go with, because it didn't get the voter approval that would be necessary to issue those bonds. So the key point here is these are real estate taxes, and we got to make sure they know they're on the hook. And so very testable to know that the issuance of GO bonds requires voter approval. Now, some political subdivisions have a self-imposed debt limit. In other words, we can't make the city or county or state do this. But I was shocked that Puerto Rico was able to borrow $40 billion before they said no more bonds for you.
Oh, wow.
Now, as a bondholder, I would prefer that the community, the political subdivision, has imposed upon it a debt limit. So I know that at some point they have to recognize and deal with their problems.
Mm-hmm.
So from the bondholder's perspective, that would be a positive factor if there is a debt limit, rather than if there is not a debt limit, they can continue to issue more and more bonds, get deeper and deeper in the hole, without dealing with the problems. I kind of joke, I think of it as like a credit card.
Mhm.
If I have an American Express card with no limit, I could take them down for big bucks. I'm sure they'd shut me down at some point. But every once in a while I'll read about some celebrity or professional athlete that had a black card and took them down for $2-3 million. Now, that was a Visa with like a $20,000 limit. We know what the worst case is for this guy or gal, right? They're going to take us down for 20. So as a bondholder, we would prefer that. Now we have limited versus unlimited tax bonds. One of the reasons the bond offering I was sharing with you failed is we have a huge senior community in Mariposa, lots of retirees, and they don't have kids. And so no surprise, they don't want to pay for the school district. And I felt like we should have done a better job reaching out to them and saying, hey, we paid for your kids and now it's time for you to pay for our kids. Public education is funded through that tax. Anyways, in that example, I think we would have had a better chance of getting the bonds passed if we would have said to the taxpayers, Dean, we think 2 mils, but no more than 3. So we're telling these bondholders we're going to go 2, but no more than 3. The tax is limited on the taxpayers. Unlimited tax would be hell or high water. So if 2 mils doesn't get it done, we go to 3 mils, 4 mils, 5 mils. Now, again, from the test perspective, we're asking you to think of this from the bondholder's perspective. And from the bondholder's perspective, I would like to be holding unlimited tax bonds. Hell or high water, they're going to charge whatever's necessary to pay me my interest. Lauren, recently, I've had people who've watched my lectures over the years, and I told the story of Reedy Creek Improvement District. And when Walt was going to build Disney World, He said, if I ever get the do-over at Disney World, I'm going to make it much different than I did it the first time. He said, one of the things I did foolishly was buy 80 acres in Orange County, California, Anaheim. And every time Anaheim, the city, or Orange County wants money, they come to reassess the value of the park. And so, well, that was a mistake. We had all kinds of zoning problems. Orange County said, you're going to build a what? A fake mountain? We don't have a fake mountain in the code book. And he goes, well, what do you have in the code book? It looks close. They go gymnasium. He goes, fine, I'm building a gymnasium that looks like a fake mountain. To this day, there's a basketball rim in the Matterhorn. Anyways, he went to the state legislature of your state, Florida, and said, listen, I'm thinking about building this thing in Florida, but only if you give me my own political charter called the Reedy Creek Improvement District. That was organized to bring Disney World to Florida years ago, and just tries Orlando and Orange County, Florida, and that's because they'd like to throw the city limits or county limits around the park and get all that money. And it makes sense that, Disney World isn't going to charge itself any more in property taxes than it needs for the infrastructure of the park. But not a bad idea, have your own political subdivision. These developers buy, again, kind of like a Disney example here, they buy 200,000 acres. They create a city, City of Oz. There's nobody in this 200,000 acres. They issue 200 million in unlimited tax bonds to build this new city. They sell 60 homes. So these 60 residents are on the hook for the couple $100 million. They're being interviewed on national television saying, our property taxes are more than our mortgage payments.
Wow.
Because they're unlimited tax bonds. They were talking about burning their homes for the insurance money. I didn't think that was a smart thing to be saying on national television, particularly when your insurance agent may be watching, right? Now, that would definitely be something you'd want to ask, Now, these bonds defaulted. It was one of the major horror stories because the homeowners lost, the people who bought the bonds lost. They were interviewing the little old lady why she bought these muni bonds. And she said, oh, Dean told me they were second safest form of credit. I'm joking, it was me. And they pay way more than other bonds. That should have been the first red flag, right? The first red flag should have been that they pay more. There's no free lunch. Now, if you break into my home and I tell you that I have a double-barreled shotgun, I'm promising you that if I miss you with the first shot, I'm going to get you with the second shot. So a double-barrel bond is a GO bond, with two promises. The user fees, but if the user fees are insufficient, then the full faith and credit of the municipality. So, Lauren, maybe I work on municipal finance, public finance. At brokerage firms, we have investment banking. We have two investment banking departments. We have corporate finance, men and women who raise money for corporations. And we have public finance, men and women who raise money for municipalities. Again, I'm talking about the primary market. And maybe the city of Salt Lake wants to host the Olympics. And I say to the city of Salt Lake as their financial advisor, I say, man, for every host city that's been a financial success, I can show you another host city where it's been a financial disaster. And if we're going to go out and try and sell $200 million and all there is a revenue pledge, a user fee from the Olympics, I'm not so sure I'm going to be able to place these bonds. What I would suggest is we make these double barrel bonds. If you bought these bonds, they would say Salt Lake City Olympic Organizing Committee revenue bonds, comma, a general obligation of the city of Salt Lake. Now, good news, there was money left over. There was a surplus. And so none of the residents of Salt Lake had to come up with any money. But had there been a deficit, they would raise the property taxes enough to pay off the interest and principal. Now, how am I going to test you on that? If I ask you to classify this as to type, it goes to the geo category. So let me give you kind of a sample question. In my example, Salt Lake City Olympic Organizing Committee revenue bonds, comma, a general obligation of the city of Salt Lake. Does that require voter approval?
Yes.
Sure does. Sure does, right? 77% of the residents said, yes, let's do it. No wonder those people are so hospitable. Have a good time, spend a lot of money. As I mentioned, it all worked out okay. So, woo, right? If it didn't work out, that would have been a problem. Now, as you see here in the slide, we have a picture of a toll road, not a freeway, a toll road. It drives me nuts because I'm originally from California. So when I go back east, it just drives me nuts that I got to throw quarters in baskets. And I'm like, oh, man, yeah. Crazy. Anyways, if we're building a new toll road, we might be afraid that people are going to use a freeway. And so, we might decide to place this toll road as a double barrel bond. We may or may not, but if you're buying it, you should certainly know whether it's double barrel or not. If it's not double barrel, that means if those tolls are insufficient, the bonds are going to default, right? Because that's the whole point of a revenue bond, by the way. The whole point of a revenue bond is if the revenues are insufficient, the bonds will default and there's going to be no stickiness to the taxpayer. In a double barrel bond, there is going to be stickiness to the taxpayers if the bonds default. All right, so we said in terms of muni bonds, we said we have GO bonds and we have revenue bonds. And a big part of your exam in this area is contrasting the two. These are backed by a revenue source. It makes sense that they should be self-supporting. Because remember, if they're not self-supporting, what's going to happen?
They will default.
That's right. That is correct. So anything we can charge a user fee can be financed with a revenue bond. So, they love these things, least likely, most likely. So which of the following is least likely financed with a revenue bond? Least likely. A bridge, an airport, a toll road, a high school. Least likely, the high school, right? We charge. No, the high school. We can charge for the bridge. I love the airport. I'm demented. I love when I go to airports to look around for a sign. Sometimes I find it, sometimes I don't. At airports I've been to, Lauren, I know exactly where the sign is because I found it. But what I love at San Francisco Airport is the sign says, your taxpayer dollars not at work. Your taxpayer dollars not at work. They're telling you that you are not paying for this bridge. You're not paying for this airport. You're not paying for this toll road. Who is paying for it?
The users.
The user. I used to joke in San Francisco, I spent a big part of my career, is I used to tease people, we don't charge you to leave the city. It's free. We charge you to come into the city. So, you're going to use the Bay Bridge or the Golden Gate Bridge. You're going to, on your way in, you're going to have to, come up with a few bucks to come into the city. When you want to leave, it also drives me nuts when I'm traveling because I don't know why they charge you on both sides. Like, just double up and be done with it. So again, we're going to charge you for it. And it says your taxpayer is not used at work. That means you're not paying for the bridge or whatever it happens to be. Let's try it again. Which of the following is least likely financed with a revenue bond? Least likely. A airport, a toll road, a bridge, a prison. The prison. We charge the prisoners. I go, what are you going to do if I don't pay? You're going to throw me in prison? I think I'm already here. Right? So in Florida, the Floridians through taxes pay for prisons. They pay for high schools. These are things that don't have user fees, right? Now, don't use your own brain housing group against yourself. Like what I mean, don't overthink, well, what about private school? And that's not what we're talking about, right? So don't be bringing stuff into questions that isn't there. So
they would be paid through general obligation bonds?
Yeah, that's right. Your school district is financed through GOs, right? General obligation bonds. In fact, when you're considering buying a house, that might be one of the things you would ask the real estate agent. What is the tax burden here and what is the return on that? I feel bad, Lauren. I used to lose all kinds of my friends in San Francisco because the school district is awful. And private schools in San Francisco are really, really expensive. And they move out to the burbs, out to Marin or out to, Lafayette. These are the suburban areas of the Bay where the school districts and property taxes are different than San Francisco, and they have decent public schools. San Francisco, not so much, but, oh, well. Now, if I work again, remember public finance. You're the mayor and I'm public finance. I say, Lauren, I know you want to build a new airport or a new bridge or whatever. What kind of new airport would you like? Would you like a nice airport, a very nice airport, or the nicest airport in the free world? You say, Dean, do I have to ask my voters? I say, no, we don't need to ask your voters because your voters aren't on the hook. Revenue bonds, Lauren, require no voter approval. So what do you think? Why don't we go for $2 billion and build us a, major international airport? I'm joking, but not really, right? I mean, there's no voter approval necessary for a revenue bond. Not a problem. If I say, You say, well, Dean, let's go for 500 million. You know, almost always, Lauren, what's going to happen is I'm going to come back and say, hey, Mayor Lauren, we've gone through 500 million already. We don't have an airport. But no problem. I could just sell some more bonds. I
Mhm.
love selling bonds. So let's sell more. It's not a problem. We almost, unless we have a debt limit, Lauren, we won't run out of money because we'll just keep what?
Selling more bonds.
Issuing more bonds.
Selling them, yeah.
All right. So very important, these documents. They're going to torment you on documents, on the test as a whole, and particularly in munis. You know, so is it the official statement? Not what we're talking about. Is it the bond buyer? You know, is it the notice to sale? Is it a prospectus? You know, now, in some circumstances, those would be the correct answer. But not if I ask you, where do we find the written promises? Written promises.
The covenants.
That's what a covenant is. That's the fancy word for written promise. You know, Lauren, every once in a while, my dad, the missionary, oh my goodness, he'll hold his Bible up and say, this is a covenant between the Lord and his people. This is a written contract. I'm like, oh my God, geez, you know, it's a little serious, you know. So you can imagine that if we're lending money to a municipality, that we want these promises to be in written form, because you can imagine how popular I would be. So I said, hey, Lauren, I'm getting out of public finance and I'm going to run against you. You're a mayor. I want to run against you as a mayor. I hope to take your place. And I say, if you elect me mayor, public transit will be free. You know, and then you would say, well, Dean, you can't do that. There's a contract between the issuer, the transit district, and the trustee for the benefit of the bondholders. And we said we would promise to charge a rate sufficient to pay interest and principal. So we have to tell the bondholders that if $3 on the bus doesn't get it done, then we go to $4 or $5 or $6, whatever it is we need to pay the interest and principal on the bonds that we use to finance, in this example, the transit district. Insurance. Oh my goodness. Anything that happens is going to be really expensive and bad. I mean, you know, we had an airliner that hit the tarmac at SFO, and I don't think it was any fault to the airport, but they sued the airport for billions of dollars. You know, in Muni in San Francisco, I'm weird. I like public transit. When I can figure it out. In San Francisco, I can go anywhere in the Bay Area in public transit. It takes me literally no time at all because I know where everything is. And, you know, if I have time and I travel, I like to kind of do that too. You know, Chicago, no problem. I know how to move around Chicago pretty quickly. But anyways, I always warn tourists in San Francisco, be careful, because there are a lot of Muni accidents, and a lot of times it's, you know, the Muni guys clipping people that are waiting on the bus stop, and they clip the curb and they take somebody out. On average, we lose about 10 people a year in San Francisco to public transit accidents. Anyways, last time I saw, they paid out a settlement for $12 million to the person that they, you know, hit. And, you know, that happens a lot. And again, we want the bondholders to know that we're properly insured. So if those kind of things happen, we don't want those things to happen, but if they do, you know, we have you know, insurance that will cover it. We have to agree to maintain the asset, because in a roundabout way, that's the collateral for our bonds. So I don't really know the credit quality of Golden Gate Transit versus San Francisco Muni, Lauren, but I'm going to guess that Golden Gate has better credit quality. That's Marin. And the only reason I'm basing that on is the buses are newer. They, you know, have Wi-Fi in them. They just look nicer. You know, I can almost make that same judgment based on airports. I've been in some airports where I go, man, you know, this thing doesn't look like it's properly maintained. Again, the bondholders want to be promised that facility will be properly maintained, because in a roundabout way, that's the collateral for their bonds. I say I should ride for free. And they go, why? I say, I am a Series 7 instructor. And they go, well, Dean, let's check the trust indenture. We did tell the bondholders that we would discriminate for senior citizens, for students, you know, veterans of foreign wars. You know, BART, for example, the employees and their immediate family members get to ride for free. That's spelled out in the trust indenture. But if it's not spelled out, then you have to pay. They say, sorry, Dean, I don't see where Series 7 instructors get to ride for free here. So you're going to have to pay your $4 or $5, whatever the case may be. I was reading about a lady who was pregnant in Oakland. And I thought, what a terrible place to be in. She didn't have anybody to drive her to the hospital. So she got on BART, Bay Area
Oh,
Rapid Transit. And she didn't make it to the hospital, and she gave birth in the BART car.
oh,
And then BART gave the kid a lifetime pass. Now, Lauren, I don't think there's some curmudgeon bondholder somewhere. Let's hope not. This is, wait a minute. I'm reading the trust indenture for BART, and it doesn't say that people born on BART cars get lifetime passes. Because the theory would be too many people are getting born on BART cars, and then we don't have any money, right? It made the news in San Francisco. Dianne Feinstein and Nancy Pelosi, and I have nothing against the ladies, but we found out that the airport was giving them free valet parking.
hmm.
And then, the bondholders did kind of raise a little bit of a ruckus and so, well, wait a minute, it doesn't say speakers of the House and senators are going to get free parking. And God knows, we're already giving them a jet to flying around. Did we really have to pay for the parking too? Right. So a lot of cash flow around, a lot of cash. And we want to make sure the money ends up where it's supposed to be. And so, we want to have an audit as a bondholder, make all that, sure that money is going in the place it's supposed to. Municipal accounting is way weaker than corporate accounting. And so when there is a problem, it's usually millions of dollars. I was reading about a guy who was skimming the Port Authority parking meters. I was kind of reading the article and kind of laughing because I thought, well, gee, how much could this be? And it ended up being millions of dollars he was skimming from the Port Authority parking meters.
Hmm.
I love, Lord, how he got caught. He didn't get caught from an audit. He got caught because the bank filed a suspicious activity report because he was depositing like 2 tons worth of quarters. And, the bank said, well, how's this guy coming up with all these quarters? Now I kind of joke he's unsophisticated because, if he knew anything about money laundering, he would know that he has to have placement. He needs to have an excuse about why he's got all these quarters. So he should have bought a vending machine company.
Mm.
Right. And I have an explanation about why I got all these quarters. Right. Then
Mhm.
you layer and then integrate. So I was kind of thinking, well, he probably should have Googled money laundering, how to. Now, I told you when we want to issue additional bonds, we love it. If I work public finance, I love to issue bonds. It's what I do for a living. And we have 2 types of bonds, again, spelled out in the indenture, either open-end. I gave you a version of this. I said, hey, Mayor Lauren, we thought we could get it done for 500 million, but we need some more money. Now, the circumstances under which we need the money determines whether it's open-end or closed. If it's open-end, this is usually typical of older facilities. So I gave you an example of San Francisco Airport. The airport's been there for several decades, and it's open-end. So as long as the San Francisco Airport meets its additional bonds test, usually debt service coverage ratio, for example, they can issue more bonds. So, I might, as the chief operating officer, say to my chief financial officer, how are we looking on the additional bonds test? Run some numbers for me, see how many bonds I can issue because I want to build a new parking structure or a new runway or a new gate or terminal, whatever the case may be. And he runs the number and says, Dean, on the additional bonds test, we are in compliance with our existing promises on debt service coverage ratio. I'll just make up 2 to 1. We're at 4 to 1. I say, okay, so how much money does that mean I can, sell in bonds to do whatever it is I want to do? Now, closed-end bonds, we can only issue more bonds to make the facility operational. And this is typical of newer facilities, right? Because we shouldn't have a need to modernize, update, or expand the facility if we just finished building it.
Mhm.
So in my example with you, I said, hey, Mayor Lauren, we did 500 million, but we don't have an operational airport. You said, well, damn, we're stuck. It's closed in. I go, no. Mayor, remember, it's closed, but as long as we need the money to make the facility operational, it's not a problem. So we issue another 500 million. We still don't have an operational airport.
Could you elaborate a little bit on the additional bonds test?
Yeah, the additional bonds test is typically going to be liquidity ratios. It could also be usage. We might say, for example, before we build a new terminal, we need to have usage on the previous existing terminals of 90% or whatever the case may be. The big one for you as a test taker, I'm not going to make you crunch this number, but the biggest financial thing we're going to be interested in is what's called debt service coverage ratio.
Is that where they can't have overlapping debts?
No, different thing, but that's testable too. I know you know that. So The overlapping debt, that's why I told you one of the challenges on the exam, Lauren, is, as I said, knowing which term goes with which. I'm going to show this to you, but overlapping debt goes with a GO bond. It's coterminous, and we'll be talking about that. So indeed, so you just got to first put it all in your brain housing group, and then you got to work on delineating it. So we're going to have a discussion coming up about analysis of GO bonds versus analysis of revenue bonds. And when we're doing analysis of GO bonds, we'll talk about overlapping debt. And you'll see this debt service coverage ratio again when we talk about analysis of revenue bonds. Okay, so call provisions, very testable. I said if you want to sound smart, anybody ever ask you about economics, finance, or investments, you want to sound smart, you should say it has a lot to do with interest rates. And if you just shut up, you sound good. Somebody says, what about them? You say, they fluctuate. They say, is that good news or bad news? You say, it depends. Can you tell me more? I say, one of the risks, Lauren, you have is that when interest rates go down, you say, well, Gene, I thought interest rates going down was a good thing. Well, I say, when you own bonds and interest rates go down in a declining interest rate environment, your bonds do indeed go up, but it becomes more likely that the issuer is going to call them away from you. So a declining interest rate environment, you have what's called call risk. And call risk is the idea that you may not be able to hold your bonds to maturity. And I say, as the interest rates go down, the call risk goes up. So test question number one, call risk is associated with a declining interest rate environment. I say, hey, Lauren, those bonds we bought? You go, God, Dean, I love the bonds. They pay 6%. Brand new bonds only pay 3%. The bonds are trading at a premium. Life is so wonderful. And I said, well, Lauren, the reason I've called you is they've passed their call protection period. And if the issuer wants to, they can call that away from you. I think the best analogy would be like a mortgage, right? If interest rates go down, I'm going to refinance my mortgage. So issuers, if they can replace high cost debt with low cost debt, they're certainly going to do so. Now, when they issue the bonds, they do promise the bondholders, test question, call protection. And so you say, hey, Dean, I'm afraid that when interest rates go down, they may call the bonds. What is my call protection? Call protection consists of two things, the time and the price. How long before the issuer can call it and at what price? They say, Lauren, the bonds are callable in 5 years. So the issuer can't call these bonds away from you for at least 5 years. But once they pass the call protection period, the bonds become callable. And I say, now, if they do call them away from you, usually they're going to give you a little bit of a prepayment penalty, so to speak, because if they call them in 5 and it was a 10-year bond, you're not going to get all those interest payments you thought you were going to get. And so it's callable at 102. So the longer the time and the higher the call price, the greater protection. So the longer the time and the higher the price, the better the call protection. Now, there are some bonds that are not callable. There are some bonds that are not callable. In other words, there are some bonds where the issuer cannot refinance. Some bonds that are not callable?
I can't think of any, but it would tell you from the beginning, right?
Well, we assume on the test that all corporates and munis are going to be callable. But we would assume on the test that zero coupon bonds are not callable. Treasury strips, treasury receipts, corporate zeros, muni zeros. So zeros are not callable. So, that means if you want to eliminate call risk, you would recommend a bond that is not callable, right? So no call risk in a zero coupon bond. And the other one on the test that you should know has no call risk is government securities. So what I mean by that is T-bills and T-notes are not callable. So the US government can't refinance its debt. So if you have a zero coupon bond or a T-bill, or I should say T-note, excuse me. If you have a T-note or T-bond, you don't ever have to worry about somebody making you give it back. But we would assume that these bonds, munis, are going to be callable. Now, the issuer, once they pass their call protection period. So you bought these bonds, these muni bonds, I call you. And you say, I say, hey, Lauren, you know those muni bonds we bought? You go, God, Dean, I love those muni bonds. You know, they pay 6, brand new ones only pay 3. I could sell them at a premium. I'm not going to, but boy, you know, I'm loving those bonds. I said, well, Lauren, they have passed their call protection period. And they said, well, Dean, why are you bothering me? I said, well, the reason I'm bothering you, Lauren, is they passed their call protection period. The issuer can call the bonds. Now, Lauren, the issuer didn't have enough to call all of the bonds. The issuer had enough to do a partial call. So they're going to call all the bonds or part of the bonds. And you say, well, Dean, how do they do partial calls? I tell you, test question. Partial calls are done by lottery, randomly. And you say, well, Dean, I always wanted my number to come up in a lottery. And I say, well, not in this one. You can take that off your bucket list, because in this lottery, you are a loser. Right? Because that means some people had to give up their bonds and some people did not. Yeah, and you don't want your bonds to be called, right?
No.
Yeah, I would like to keep them. Now, the MSRB, you know, one of the things, Lauren, is on the test, we got to believe in human depravity and original sin. And we didn't have any kind of rules that, you know, people would take advantage of folks, right? So I call you and say, hey, Lauren, you know, interest rates have gone down. I got a bond that pays 6, brand new ones only pay 3. And you should say, well, Dean, don't I have to pay a premium for that? I said, well, you're no fun. I said, okay. After you pay the premium, you still have a yield to maturity of. And you say, well, gee, Dean, shouldn't you be quoting yield to call to me? So the MSRB says these call provisions need to be disclosed with one testable exception. So these call provisions must be disclosed with one testable exception. And that one testable exception is a catastrophe call. I don't know, Lauren, if I'm ever going to get to teach ever again a live class, you know, and maybe someday. But when I taught live classes, I taught a lot of live classes in San Francisco, and I was telling the story about the Embarcadero, the wraps around the city used to be a very ugly freeway tollway where you would get off the Golden Gate Bridge and you'd pay and you'd wrap you around the city. And, you know, it was ugly. And then we had an earthquake and the thing fell down and we go, oh my God, it's so much more prettier without that ugly freeway. And so you call me and say, hey, Dean, I just saw that the thing fell down. What happens to my Embarcadero tollway bonds? I go, we're using the catastrophe call. We've decided, Lauren, that we're going to build a beautiful promenade around the waterfront with some palm trees and a little train to take people to the Giants game. It's going to be really pretty. And, you know, while the hotels were like, oh, this is wonderful. Now we have more ocean views or bay views. And you say, well, Dean, you never disclosed to me the catastrophe call. And I say, well, Lauren, the MSRB says I need not disclose catastrophe calls. I mean, it's bad energy to be talking about acts of God, natural disasters. So this is the one call provision that the MSRB says need not be disclosed to customers. Anyways, when I was teaching that class in San Francisco, the guy said, well, that's why I don't live in San Francisco or California, earthquakes. And I was going to say, let him slide. I said, well, where do you live? He goes, Oklahoma. And I go, well, yeah, don't you guys like have like tornadoes or stuff? He goes, well, yeah. I go, okay, so a tornado blows the thing down. Right. So this is the one thing the MSRB says needs not be disclosed to the customer. Now, remember, big picture, we're talking about documents. So this catastrophe call could be discovered by a customer if he chose to read the what? The trust indenture, right? This is the trust indenture. It tells you on the trust indenture. Now, put provisions are becoming very much more popular today because we're in a rising interest rate environment. So again, not all bonds have a put provision. So call provision was advantageous to the issuer. A put provision is advantageous to the bondholder in a rising interest rate environment. I always thought if I had to come back again as a broker, one of the things I'd like to do, public finance or selling muni bonds. But I started out when I was relatively young in the business, and I did sell a lot of municipal bonds and muni bond funds because being a young guy, I thought, well, gee, it's kind of much easier to sell somebody a tax-free bond than a lot of other things. I mean,
Mhm.
hey, doctor, you interested in 5% tax-free? It gets rid of a lot of the other clouding, issues. But anyways, let's say I'm trying to sell you the bond. I say, hey, Lauren, I've got this muni bond I'm pretty excited about. I'd like to share it with you. And you say, well, gee, Steen, it has a higher price and a lower yield than I've seen on other bonds. I say, well, I'm not really surprised, Lauren, that it has a higher price and a lower yield because it has a put provision. This is a nifty thing. After 5 years, Lauren, if we want, we can put it back to the issuer. You're going to pay for it. It's not going to be any kind of a free lunch here, right? So
Mhm.
here we would expect this to have a higher price and a lower yield. That's going to be doing it. Now, flow of funds is very testable. There's a couple
Yeah, I
tests.
actually remember being tested on that. I thought it was.
Yeah, it's testable. So first test question is, where do we find the flow of funds? In the official statement? The trust indenture. There we go. Ding, ding, ding. So we're talking about this trust indenture. We said this trust indenture is very testable. And we said it has lots of information. It's the promises. I had a young man in one of my classes. He had got his first home loan. He told me he was going to come back after lunch. He's going to go get the mortgage, officially sign off on it, and be back. I said, is this the first time you've signed mortgage papers? He goes, well, how'd you know? I said, because only somebody who's never signed mortgages thinks they can do that during a lunch appointment. I said, trust me, it's going to take you more. He goes, well, it's just a promise to pay interest and principal. I go, oh, no, 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 no. That indenture on that mortgage has lots of promises. That's the big one, but there are others. Now, I'm sure they're going to give you a free look. I would imagine they're going to say you can sign in now and take it and leave for 3 days and come back and, because they probably have the expectation you're not going to read it over lunch. Anyways, long story short here, in terms of the indenture, right? There's a lot of promises in this thing. And one of our promises is, where are we going to put the money? Now, I'm familiar with San Francisco Airport and how convenient they have a Bank of America branch right there at the airport. That is pretty nice. So let's talk about the airport's finances. They're going to be collecting gate fees. They're going to be collecting money from the parking structure. God knows I have spent hundreds of dollars, sometimes more, on the parking than the airline flight to go where I'm going and back. We're going to have restaurants that are making lease payments in the food court. We've got retail. So where we're asking is, where is all that money going to go? And test question, we assume on the test net revenue, very testable. We assume on the test net revenue. And we would say on the exam that the fund that has priority, is the operations and maintenance fund. And then once we have enough to operate, maintain the facility, then it goes into debt service. Now, gross revenue would be penny wise and pound foolish as a bondholder, because to say you want to get paid off the top is foolish, because then if we can't operate, maintain the facility, then that's going to be a problem, right? Because we can't take off and land the airplanes or whatever the case may be. So let's just review a couple of test questions here. Test question number 1, where do we find the flow of funds? We find it in the trust indenture. Test question number 2, there are 2 types of promises or pledges. There is net revenue and there's gross revenue. It's not testable, but it is, because if you don't know this, then you won't be able to perform. We assume on the test net revenue unless we're explicitly told it's gross. And under net revenue pledge, test question, the operations and maintenance fund has priority. All right, let's finish this up. We want to have a natural break when we finish up that's kind of a natural break. Let's see what we got here. Oh, let's finish up this part before we call it a day, so we'll know where we're at. So I started this discussion, Lauren, by saying there are only 2 types of municipal bonds: GO and revenue. That's it. But there are a zillion subcategories. But at the end of the day, it's either a GO or revenue. I think Mr. Boeing would be rolling in his grave if he knew they moved the headquarters of Boeing out of Seattle. And before they did, Boeing said, attention, Dallas, Denver, Chicago, we're coming to one of your 3 cities. And I go, ooh. City of Chicago has an industrial development agency charged with luring employers into the city of Chicago. And they said to Boeing, have you given any thought to the corporate campus you'd like? Boeing says, coincidentally, we have an architect rendering of the campus we'd like. Have you given any thought to computers, furniture, training that you're going to need? They said, coincidentally, here's an inventory list of everything we'd like. Chicago said, if you will come to Chicago, we will build that turnkey to your specifications ready to occupy. And they, wow, how are you going to do that? They said to Boeing, we're going to issue some industrial development revenue bonds, and we're going to tell them that the lease payments you make pays the interest and principal. You know, this was a 20-year bond, and that 20 years is up. It makes sense that the bonds will be for the term of the lease, but now Boeing, I just told you the lease is up and the bonds have been paid, and now, Lauren, Boeing is saying, attention, South Carolina, Texas, Florida, it looks like they're going to move again out of Chicago. Now, how would I test you on this? Let me give you an example. So when these bonds were issued, Chicago's credit quality was BB. And Boeing's credit quality was single A. So are these bonds rated BB or single A? Single A. Corporate credit backs the bonds. You know, Denver has an industrial development agency, and the Industrial Development Agency of Denver built Schwab, an 80-acre campus in Lone Tree, Colorado, Denver. Wow. And they issued the bonds, and then they just told Schwab to, you know, come here, and here's your buildings and your parking structure, and all you need to do is hire 4,000 Coloradans. By the way, not all Coloradans, I'm not sure I pronounced that right, but a lot of people from California said, sign me up. You know, I want out, you know, and now they moved the corporate headquarters to Westlake in Texas. They actually own that building, but this is a lease payment. Let me try one more with you just to see if you're getting the hang of this. Gilroy, California, garlic capital of the world, is AA. Gilroy has an industrial development agency. Surprise. I mean, you think they would just stick to agriculture, but they built a motorcycle manufacturing facility for a company that was not rated. It went bankrupt. They were going to put Harley Davidson out of business, didn't quite work out. Is there any stickiness to the residents of Gilroy? No. And test question, Gilroy just told you who's AA, and the motorcycle manufacturing company is not rated. Not rated goes on the bonds. One more test question here. One more test question. Suitability. So, you know, people who buy muni bonds are in a very high tax bracket. In fact, a lot of times on the test will say, your customer is an uncomfortably high tax bracket. You go, oh, muni, and in terms of suitability. Or they say, your customer's in a very low tax bracket. Ooh, muni's unsuitable. Now, one thing I like about munis is the three styles of questions you get on your exam, Lauren, are recognition, practical application, and judgment. And suitability questions are judgment questions. They're kind of like, oh man, I don't know. Do I give them like a 50% growth fund and 30% bond fund? I mean, with munis, the suitability questions are a little more straightforward. They're really more aim and shoot than they are for other investment vehicles. And so I say, Lauren, are you subject to the alternative minimum tax? It's a simple yes or no. It's a binary suitability question. And if you say yes, then this becomes an unsuitable recommendation for you. Because I say, Lauren, these industrial development bonds we're talking about are non-public purpose bonds. I mean, in my examples I gave you, the primary beneficiary wasn't Chicago or Denver or Gilroy. The primary beneficiary was the corporation leasing the facility. And therefore, since these bonds are supporting a private activity, now that's what the IRS calls these bonds. That's not, you know, what we call them, but, you know, the IRS, you know, calls these private activity bonds because that's what they're supporting. And the test question about private activity bonds is, again, we don't recommend them to somebody who's subject to the alternative minimum tax. Now, there's another bond that's very similar. And the other bond is a bond that does serve a public purpose. As you can see here in the slide, it says non-public purpose. This bond does serve a public purpose, but it's not essential. Now, don't throw rocks at me. I'm not the one who says that. That's what the IRS says. It would be nicer if the IRS would just call this what everybody else calls it, a stadium.
Mm.
Now I'm coming to you from Clark County, and we built the Raiders with $500 million of public assistance, industrial development revenue bonds. We issued $500 million to the Allegiant Stadium. And again, the primary beneficiaries are the Raiders, not the city of Las Vegas. And so that bond serves a public purpose. 50,000 of us get to bond over the Raiders losing another game, but it's not like building a high school. And so the same suitability rules would apply. The same suitability rules would apply.
Cool. Okay.
So again,
So I
it's be a binary question. So as I mentioned, it's going to be just recognition that it would be unsuitable for some to chub DMT. Usually it's about 200,000 in income. So if you make a couple hundred, let's just use Dean as an example. So I'm coming in from my studio here in fabulous Las Vegas, and I only use this studio for professional purposes. It's not like I'm in here making, videos about anything other than passing exams, and I use it to do this stuff. So it would be deductible for me. I say I got this studio, and for most people that'd be deductible. Now, if I make a couple 100,000 a year and I start taking deductions, and now when I'm done with my taxes, it looks like the rest of the citizens of the Republic owe me 40 grand for being a citizen. Then they say, Dean, try it again using this alternative method. And that basically means everybody's going to end up owing some taxes. Nobody's going to be able, we call these things that rich people will do preference items. So the studio now becomes a preference item. Private activities become preference items. All that means in plain English is they become taxable. You don't get to deduct them, or you don't get to collect the tax-free interest. And so that means, it's again a suitability question. Now, I like this word special tax, not a general tax going into the general budget, a special tax. Sometimes we call these sin taxes. Sin taxes. You shouldn't be smoking or drinking or being at a hotel. You should be at home. Now in San Francisco, I'm no longer a resident of San Francisco, but when I was, I prided myself on being number one in the country. San Franciscans are number one on booze, books, and fine dining. I joke we're the most educated drunks in the country. And Morgan Stanley was hired by the city of San Francisco to help them come up with an idea about how to finance an alcohol rehab center. And Morgan Stanley said, do you have a general tax on alcohol sold within the city that goes in the general budget of San Francisco? And they say, yeah, in San Francisco, drink a lot. It brings in about 35 million a year. Morgan Stanley says, we don't want to mess with that general tax that goes in the general budget, but we've run some numbers. And what we think you should do is issue a special tax bond and tell the bondholders above and beyond the general tax on alcohol sold within San Francisco, there'll be a special tax. Now, listen, in my tribe, Lauren, if we tell you have a drinking problem, you have a drinking problem, because we're not predisposed to tell people that. And I said, Johnny, you got a drinking problem. And I checked him into the alcohol rehabs in San Francisco. And he said, Dean, I feel so bad, all this infrastructure for me. And I feel bad, like I'm taking advantage of the taxpayers. I go, Johnny, don't feel bad. You and I are paying for this place. This is financed through a special tax on alcohol sold within the city. So if the people don't drink, then they're not paying the tax and they're not on the hook for this thing. By the way, we got to be careful, because if too many people stop drinking, the bonds default. Right. So we don't want all the sin to go away. If all the sin goes away, I think, Lauren, there's going to be one guy left paying $5 billion a pack for his cigarettes, $4 billion in taxes and $1 billion for the cigarettes. Right. So again, California has a tobacco bond they sold, and saying that the special tax on tobacco is what pays the interest and principal. I love, Lauren, that they didn't call it California. They called it Golden State Tobacco Bonds. And the reason they didn't use California is because they don't want you to think this is a full faith and credit California. No, it's the special tax. Hotel or motel tax. I just gave you an example of this one. The Allegiant Stadium is financed with a hotel or motel tax in Las Vegas. So if you go to stay in your hotel, you'll find out there's a special line that tells you owe extra. So, a lot of people get upset. I had a guy who got it was a real free room, but it still cost them $1,000, because what they can't waive is all the special taxes.
Wow.
So, go for the Allegiant Stadium, and it goes for this or goes for that. The worst state I've ever been in is New York. My God, there's line after line after line of special taxes that the hotels are collecting that go to the Momo or whatever it's going to, right? That's not a general tax. It's a special tax, a business license tax. I say, what business are you in? And I could have a special tax on that. I had to go to sin taxes again. One of my favorite was Dallas, Texas, came up with a poll tax, POLE, poll tax on strip clubs. And they said, if you have strip clubs, you're going to have to pay, charge a cover. And this money you're going to charge for the cover is going to go into a special fund for women's health. They could issue some bonds and, okay, it's kind of an interesting way to do it. Again, these are things we can tax. In California, we had a sneaky snacks tax, an excise tax on unhealthy snack foods for you. So you want to buy like a ding dong or whatever, it's going to cost you some money. And then gasoline taxes, and as you see here, taxes other than ad valorem. And then I like a little pictures we have here for you. Against the benefit of property. So benefited property would be like, in California, I used to drive from my mountain place to San Francisco. It's 170 miles door to door. And when I get to Highway 99, head north, when I get to a little town called Ripon, California, you go left to San Francisco, you go right to Sacramento. It's truly a fork in the road. And Flying J Truck Travel Plaza asked Caltrans, Department of Transportation, State of California, would they revamp the freeway system to make it easy for 18-wheelers to get in and off that off-ramp at that fork in the road? Because they were planning on building a huge Flying J. And California said, we're going to do it for you. It's going to cost $20 million, and we can't ask the residents of California. So they issued some special assessment bonds. If you bought these, Lauren, on your confirmation, it would say Caltrans Highway 99, off-ramp 93, special assessment bonds. And what's going to happen is the Flying J is going to have an assessment against it to pay the interest and principal on those bonds. Now, if I sold those bonds to you, I'd say, Lauren, why did you check out the Flying J? Because as the Flying J goes, so goes the bonds, right? If for some reason they, default or whatever, again, the point here is there's no stickiness to the taxpayers of Ripon, California. One more example. I have 10,000 acres in Summerlin, I wish. Raw land, desert land, it's across the street from me. Howard Hughes does. I don't. He's dead, but he had tens of thousands, still does, of acres. I'm going to build a new development called Coyote Springs. And I'm going to put 4 homes per acre. I'm going to build 40,000 homes in Summerlin. And someone's going to say, Dean, we're going to need more schools. We're going to need more infrastructure. We can't expect the existing residents to pay for that. When you sell the homes, will you tell them they live within a special assessment district? And besides the normal property tax that everybody pays, they're going to pay extra. Now, I have seen developers advertise that their developments aren't special assessment districts, saying, well, when you buy a house here and you move in, you just pay the same infrastructure that everybody in this community pays. I've never seen a developer who advertises this is a special assessment district and you're going to be paying extra. Right? So, but maybe you want to pay the extra for all the, landscaping and new schools and all that cake. Now, I always joke about moral obligation bonds. As we said, I've seen you booked some sessions here, and you don't want me to be morally obligated to show up to these sessions, because that means I could come up with some philosophical reason about why I don't need to show up. You say, Dean, hell or high water, I expect you to show up. Now, for a lot of smaller rural communities, for example, they have like rural hospitals. And, rural hospitals are precariously financed because a lot of people would prefer to go to the big city where there's big city doctors. And so maybe this hospital revenue district asked the state of Florida, would they be morally obligated to pay back these bonds? And the state of Florida's legislature says yes. So if you buy these bonds, it says Ponce de Leon Hospital Revenue District bonds, comma, a moral obligation of the state of Florida. And, they take over, you do it. Let's say that hospital defaults. So the state legislature takes a vote and says, all in favor of paying back the Ponce de Leon Hospital Revenue District bondholders say aye. All opposed say nay. If there's more yays than nays, you get paid back. If there's not, the bonds default. And if you get this as a test question, the whole process I just brought up there is called legislative apportionment. So that's a term associated with moral obligation bonds. So they'll say what term is associated with moral obligation bonds, and you would say legislative apportionment. Now, surprisingly, they have a very good track record because, you know, when the state legislature of Florida goes to take the votes, I say, state legislatures, before we vote on the moral obligation bonds that the hospital revenue district has issued and they've defaulted, I'd like to point out the presence of the men and women from Moody's and Standard and Poor's and Fitch's, and they're here to see how we're going to perform as the state of Florida on our moral obligation. And if we don't make good, they're going to ding our credit quality. That's going to cost the state way more money than if we just took the money out of the budget and paid it. You know, in the scheme of Florida, maybe this is a $10 million bond deal. That's not a big deal, right? So surprisingly, they have a very, very good track record. Now, the last one we want to talk about is neither fish nor fowl. You know, I wouldn't really actually put it in this category, but it's low-income housing, public housing authority bonds, or national housing authority bonds. I say, hey, doctor, how about buying the public housing authority bonds or national housing authority bonds? You can collect some tax-free interest. And you say, well, Dean, I'm worried that people can't pay their rent. I said, well, you don't need to worry about people paying their rent. Test question, public housing authority bonds, national housing authority bonds, test question, have the full faith and credit of the United States government. That's very testable. There are 3 ways to avail yourself of that credit quality. Listen, on the test, whenever there's 3 of a thing, you can stand by for the accept question. All the following have the full faith and credit of the United States government, except. So if you say, Dean, I'm very risk adverse, and I want the best credit quality possible. I say, well, Lauren, the best credit quality possible is that of the United States government. You know, the US government can print the little green pieces of paper they owe you. So, you know, that's pretty cool. And they can confiscate money from others. So what's another way to avail yourself of this credit quality? Another way would be direct obligations of the US Treasury. That would be T-bills, T-notes, and T-bonds. Now, as I mentioned, that whenever there's 3 of a thing, that's what they love to ask you on the test is accept. So one more. Do you know another one that has the direct full faith and credit of the United States government?
Federal home loans?
Ginnie Mae's. No, that would be the D choice, which would be wrong. The other ones have an implied backing, but not a direct backing. So it'd be PHAs, NHAs, direct obligations of the US Treasury, and Ginnie Mae's. Ginnie Mae's, 3 test questions on Ginnie Mae's. Direct obligation, they pay interest and principal monthly. Test question, it's the only investment on your exam that pays interest and principal monthly. And unlike the PHAs and unlike the direct obligations, it's fully taxable. Now, those other ones you brought up, I'll put it in a different color, are the ones that aren't directly backed, but have the implied backing. We assume that the US government would provide assistance for Fannie Mae or Freddie Mac or the Federal Home Loan Board, when, you know, once you brought up Sallie Mae, but they're not directly backed, right? So, you know, we could expect an accept question about this. All right, well, we ran over, but that's okay because I owe you some time. So I killed part of it here. And I think that's a natural break in the material. So if I don't have a hard close, sometimes I'm all booked. And I think it's Monday, our next session.
Yes.
And so that's going to be, I think, a harder close because I'm completely booked on Monday.
Okay.
But for this, we don't have a hard close. If we don't have a hard close with a natural break in the material and you have the time, I would